All right, ladies and gentlemen, welcome back to Finom Group's weekly State of the Market. I am your host, Seth Golden. Looks like a pretty good storm we're having today here in the markets once again. I promise you folks, this is not the state of the market's fault, even though it seems like every single Thursday the market is down. And not just down, but down more than 1% on most of these Thursdays. And it's not hyperbole, folks. Look at the chart. S&P 500 is not liking Thursdays in 2022. This will be the seventh Thursday in 2022, and more than likely it's shaping up to be the seventh down Thursday in 2022. 2022, yeah. So indeed, market has been red every single Thursday this year. And right now, S&P 500 is pretty much at the lows of the day, trying to hold on to that round number there. Never mind. Probably best to look away at this point. But indeed, Thursday has not been good to the S&P 500. We got more headlines overnight into the morning regarding the conflict between Russia and Ukraine. One day the headlines are favorable, the next day not so much, but that's what you get when you're trying to deal with dictatorships, I guess. So, trust but verify, I think is the phrase. And what we've been verifying is that you can't trust what is coming out of the Kremlin. Anyways, with that being said, here we are, down more than 1% across all the major averages. NASDAQ down 2% here today. But not all is lost. We still have a lot of time left in the year, folks. Healthy reminder, if I may, our 1982 analog at this point in the year on February 17th, 1982, the S&P 500 was down about 7.25%. As of February 17th, 2022, the market is down a little more than 7.25%. That 1982 analog still in play, folks. Let's take a step back, however, to last Thursday. Last Thursday on SOTM day, it was a volatile day which ended near the lows. The day before, Wednesday, we had an 80% up volume or up advancing issues day, followed by Thursday, which was a down 80% issues day, meaning you had 80% of stocks were declining on Thursday. On Wednesday, we had 80% of stocks rallying. So we did a back test of that circumstance, and the back test of similar events during the last 10 years show a surprising high win rate if you look out 3 months. The win rate was 95%. 95%, and the average return, 7.64% higher for the S&P 500 over that 63 days. Why 63 days? Because there's about 21 trading days in a calendar month. So 63 days is the equivalent of 3 months. But a 95% positivity rate when you've had a 80% advancing day and then an 80% declining day. So do keep this handy, folks. We have tempered expectations for equities in 2022. We zeroed in on what happens during years when the S&P 500 has eked out a modest positive total return since 1958. And here's what we find. The S&P 500 has posted a modest positive total return, like 0 to 5% total return for the year, in only 6 years. Over the last 6 decades versus an average total return of 12%. What were the years that had only a 0 to 5% gain? 1960, less than 1%. 1970, 3.6%. 1994, 1.3%. 2005, 4.8%. And 2011, 2.1%. 2015, 1.4%. Those were the only 6 times that the S&P 500 had a 0 to 5% modest gain for the year, going all the way back to 1958. The average 2.3% of those 6 years. That was the average return. Seems like it's extremely rare to have a small gain on the year. Either you're going to be down or you're going to be up more than 5%. And people always talk about what, the average returns, This chart, it's kind of funny. Returns are all over the place, right? Here's the 0% return. These are all the dates. 1930, 1929, 1928, 27, going all the way out into the future last year, and they're all over the place. I mean, rarely do you get the average return, right? So do keep that in mind, and good luck predicting what's going to happen from one year to the next. If you want consistency over the long haul, you have to accept lower returns. If you want higher returns over the long haul, you have to accept more volatility. You can never truly escape risk. Just change how you accept it. Risk is part of the business of investing. And again, here are those years: 1960, 1970, 1994, 2005, 11, and 2015. So during these so-so years, if you will, the S&P 500 is usually down in January, but up in February. Down in January, up in February. Unfortunately, as of today, we're down more than 2%, a little more than halfway through the month of February. The S&P 500 has only bottomed for the year between Q2, the second quarter, and the fourth quarter, when it ends the year up less than 5%. So even if you think the S&P 500 can squeeze out a modest gain in 2022, there's still likely more pain to come, since the index does not typically hit its annual low until at least Q2 during these modest gain years. During those modest gain years that we mentioned above, the market bottomed in October, May, April, October again, and August. You usually don't bottom in the first quarter. As I've said before, I don't think the lows are in. If they wind up, being in, so be it. I mean, I'm positioned long. I'll be okay with upside. But if the bottom isn't in, you want to have that cash on the sidelines so that you can, engage the market in the dip buying activity, assuming all of our buy the dip indicators are still flashing green, which as of today, yes, they still are flashing green. February, typically, the middle of the month, start to rally. Typically, monthly options expiration week, which is this week, tomorrow is monthly options expiration, Friday. It's a good week for the S&P 500. It's a good week for the major averages, with the Russell performing the best during monthly options expiration week. But unfortunately, we are looking red at this time. Still have one more day. The headlines can shift just as they have been all week. So keep an open mind. All right, shifting gears a little bit here. Tech. Right? Tech has been under a lot of pressure. It seems like from one day to the next, the NASDAQ, the Qs, they're up big, then they're down big. There's just no rhyme or reason lately. And a lot of this is predicated on headline fears, geopolitical, or Fed-related fears. Nonetheless, tech net allocation fell to the lowest level since August of 2006. The latest Bank of America Fund Manager survey, I'm sure a lot of you are familiar with their monthly survey, it shows clients the most bearish on tech since 2006. Right. You've heard of contrarian indicators and whatnot. I wouldn't suggest that this is not a contrarian indicator any more than I would suggest it is, but beware they're not. And apparently, they're the most bearish on tech. They're not in tech. Now take a look at the following. Here's the thing. Grains of salt, folks. Grains of salt. Now take a look at the following chart from the same Bank of America Fund Manager survey. What do you think is currently the most crowded trade? Long U.S. tech stock. I kid you not. These are so useless. It's scary. It's scary. What do you think is the, and people get hung up on that word, right? Well, they think it is. It may not be, but you can conflate it, folks. You can conflate it. It's just ridiculous, these surveys by Bank of America. I promise you, the B of A fund manager survey is the most useful of all surveys. Sarcasm, heavily loaded sarcasm. Tech is the most crowded. Tech is the most crowded, but tech is the most hated. Surveys are crazy. Hated by maybe the fund managers, but certainly not the corporate insiders. Still loading up, folks. And I know we've shown this chart before, but they keep loading. Corporate insider buy to sell ratio for the technology sector is just extreme at this point. There's no more bullish indicator long term than what the insiders are doing. On average, in general, yeah, you'll get your dumb CEO or dumb CFO that's buying and it's stock keeps going down. But that's far and few between. Far and few between. All right, we've talked about cycles. We're done with the early cycle. I think I've pounded that drum to death. But we've also been highlighting the NASDAQ new highs minus new lows. And if we're going to see a sustained rally and get back above the 250-day moving average in the NASDAQ or in the Qs, we need to stop seeing so many new lows. We need to see more new highs. But with the chart of the NASDAQ, new highs minus new lows, we can also see the regime change. This is the early cycle. This is the everything rally. You have an upward slope to the new highs minus new low ratio. But look what has happened since basically about mid-March last year. We've been making lower lows. And of course, the plunge here. This looks like capitulation here in the new year. And now we've been chopping around this level. But either way, we're making lower lows and lower highs. It tells you you're in a new regime. You're in the mid-cycle phase of the bull market. More outflows from tech, more outflows from Qs. The QQQ, this is going back to last week, continues to feel the pain of daily, weekly market swings. Investors pulled nearly $3.2 billion from the NASDAQ 100 ETF on the 10th of February, the biggest outflow since September of 2020. Takes the total year's outflows to $7.6 billion. That's called a lot of deleveraging, folks. I mean, you look at this looks like a washout there. If that doesn't look like a washout, I don't know what does. So you're seeing a lot of these capitulatory signals in the NASDAQ pretty much since the middle of January. All right, the advanced decline line for the NYSE also shows the breakdown of market breadth easing into the mid-cycle phase, right? Everything's working throughout 2021, but a lot of chopping around here. And now we are below what used to be support in the NYSE advanced decline line. We're playing in this range now. It's a new regime. It doesn't mean we can't get beyond this, because ultimately we want to see new all-time highs in the indexes supported by a new all-time high in the advanced decline line. We want breadth to actually lead price. But most importantly, we want breadth to confirm price if we do, make new all-time highs. But right now, again, another kind of way to look at the transferring from one cycle of the bull market to another cycle of the bull market. Every time we've tried so far here in the new year to get back above this former support line, it's proving to be hard resistance. A lot of volatility this year, it goes without saying probably, but keep in mind, and what this chart demonstrates, or this table demonstrates, these are all the VIX ranges, 10 to 12, 12 to 14, 14 to 16, so on and so on as volatility increases. These are all the sectors across the top. all the sectors within the S&P 500. And you'll notice that at the bottom, you have the higher VIX levels, but there's a lot of green, right? You're more green shades. This is looking out over a 12-month period. You know, when you get the VIX at these higher levels, usually the forward returns are pretty extreme. 12 months later, when the VIX hits 45 to 50, industrials are up 98%. More than likely, they were down a good 20 to 30%. I mean, this is probably a nice correction. 45 to 50 on the VIX, yeah, more than likely, that's like the climactic period of volatility and probably the depth of a correction. So the point here is when the VIX is high, it's time to buy. When the VIX is low, like it is here, usually the returns are lower too. It doesn't mean the returns are negative all the time. It doesn't mean that at all. But they're less than when the VIX is really high. When the VIX is high, it's time to buy, folks. Volatility is opportunity. You've probably heard me say that many times in the past. Again, speaking of volatility, speaking maybe of hedging, right? You see a lot of hedging activity. This is the 10-day put-call ratio. And just like the advanced decline line showed that we might be in a different regime, in a different phase of the bull market, and going through a corrective phase, the 10-day put-call ratio is showing the same thing. We have a lot more hedging activity here in 2022. We have a lot more people buying puts in 2022 than they are buying calls. Again, used to be resistance. Now it's support, but not in the best way because we're talking about folks hedging. That's what they're doing. Investors are hedging, clearly. All right. Hedging, poor breath, poor market breath, whether it's any indice, pick any indice. We've got a lot of bad market breath. If we don't see these new lows start to subside with respect to new highs, more than likely, that is also a sign that we haven't quite hit the bottom. The indexes are vulnerable to more downside. Having said that, and even though we see a lot of hedging activity, cautiousness on the part of investors, when we look at the defensive activity, stock picking, sectors that are defensive, the utility, it doesn't really get much more defensive than utilities, staples, healthcare. But look at the ratio, the performance ratio of the utilities versus the S&P 500. It's been on a steady downcline ever since here. Maybe this is, investors starting to get bullish, or maybe, this is just everything is going down, but the S&P 500 is just not going down as much as utilities. Well, we'll keep an eye on this ratio, but it is interesting that one of the more defensive areas of the market is still underperforming in this environment. Thinking of utilities, thinking of the defensive posture here, this is a trading model that measures the difference between medium-term uptrends for the S&P 500 and S&P 500 utility sector members. It registered an alert on Monday at the close of trading. The sentiment trader, this is from the sentiment trader, showed that the model identifies when the spread between members above their 50-day average reverses from negative 50, down here, negative 50, to greater than 11%, right there. The reversal in medium-term trends in this ratio suggests that the broad market is potentially transitioning from a more defensive environment to a more risk-seeking one. Might also indicate that interest rate sensitive stocks have succumbed to the pressure of higher rates. And that might be what's going on in this performance ratio, why utilities are not necessarily getting the bite, the risk appetite that we typically see in a defensive environment. It remains to be seen. Nonetheless, we don't need to speculate. We've seen this in the past. The signal triggered 35 other times over the past 68 years. After the S&P 500 future returns, the win rates and the risk-reward profiles were all excellent across all time frames, especially over the next 2 months. We'll see if that's the case this time. All right, we know if it's not Russia, Ukraine, is the Fed going to hike 50 basis points or 25 basis? We know they're going to hike, though. One of the things you probably heard a lot about this cycle being different, right? Everybody said, well, the PE is elevated. We're going into a rate hiking cycle with elevated valuations, high PE ratios. We've never done that before. Bull crap, bull crap, bull crap. Nonetheless, the little picture, that's the little picture. If there's a big picture, little picture, that's the little picture. The big picture is that, like I said, it's bull crap. That has happened before. We can go and look at all of these dates. I'm not saying all of these dates had a comparative high PE ratio to the previous 4, 5, 10 years even. But I am saying some of them absolutely did. 1999 is just one example. So here's another example, right? Because 1971, the Fed hiked rates. The PE was 19.2. So here's the chart. I had to go do this, all myself, so forgive me for the rudimentary right here. 1973, 71. There we are. 19.2 PE. Now look back in time. Is this higher than 1968? That's 4 years. We can go all the way back to 1961. We'd have to go back 10 years to see that the PE ratio was the highest, was elevated going into a rate hike cycle. So what was the returns after that? Right? Because, okay, good, Seth. So everybody's lying. You figured it out. Good job. What does that mean for investors? And again, every rate hike cycle is different. But valuations are just, they don't tell you anything. They just are not a useful, I don't know if even the word tool should be used, because they're just not useful in determining forward S&P 500 returns. But the S&P 500 from February of 1971 until 1973, January of 1973, it tacked on 28% returns with an elevated, highest in 10 years PE ratio. We can do this on a number of these. I want to say, obviously, 1999 is a bad example. But let's do 86, right? Right in the middle there. Let's do 1986. Let's go check it out. See what we were doing in 1980. There's a peak there, folks. 1987. Yeah, I mean, we have to, right? So at a 17 PE ratio, this was the highest PE ratio since, you have to go all the way back here. And again, this is February 1986. What was the month we're looking for? 1986, they started November. Right, the crash didn't happen until November. I'm sorry, October of 1987, Black Monday. Black Monday, right? That was a year later, almost a year later, 11 months later. So yeah, we've done this many times before. I just picked that one at random. 1986 was the highest PE ratio in more than 10 years, and the Fed was hiking rates. So all of this fear mongering about, yeah, but we're going into a rate hike cycle with elevated PEs, it doesn't mean anything. It's just more nonsense. So wanted to dispel or debunk that nonsense for you. This table here is really cool. I like it because this is the table above. It outlines the S&P 500's performance 12 months into the first rate hike, so leading up to, so 12 months before and up to the first rate hike, and 12 months going out from the first rate hike, going forward. The average return since 1972 rate hike regimes is in the second to last column here. And, you know, they're almost all positive, folks. 12-month returns, they're almost all positive. The maximum drawdowns for each year is in the bottom row down here. 9.9%, 12% in 1984, 12% here in 99, 13% in 2015. Folks, we're already down on, 7+% this year. We're already down 7+%. The average maximum drawdown, average maximum drawdown is 9.6% over 12 months beyond the first rate hike. So pretty useful table in my opinion. Are they going to hike 50 basis points or are they going to hike 25, right? Last week, now this comes from the CME Fed Watch tool. Last week, the 50 basis point probability was 96%. Last Thursday, after the CPI data came out, hotter than expected at 7%, 7.5% annualized. This shot up to 96%. Look where it is today, folks. It came all the way back down. These things move a lot faster than Fed policy. The Fed meeting's not until March 16th. This will change every hour of every day, folks. But from last week, 50 basis points, and you're still hearing that mantra here this week, even from some of the Fed members, like Federal Reserve President, the St. Louis Fed President, James Bullard. He wants a 50 basis point hike. But it doesn't seem like all the Fed members are on board with that. He's just one voting member. He was not a voting member last year. He's a voting member this year. But again, these are going to change every hour of every day up until the March meeting. What is the relevance? And maybe I've gone over this before, maybe I haven't, so I do want to make it clear. Historically, if you are above 60%, 60% or better, whatever the action is being priced in, whenever the probability of action is 60% or better, that is what the Fed has done every single time. So when people contemplate, will they, won't they, there's no guesstimates. There's no wonderment. Just go to the CME Fed Watch tool and see what the probabilities are. As long as you have 60% or better probability of whatever action it may be, that is what's going to happen. Let's get a refresh here and see where we stand at this hour of the day on Thursday. It's down to 32% now. 32% probability of 50 basis points. And this is the one that is still above 60%. If this is above 60% going into the meeting, the day before the meeting, folks, this is what's going to happen. You can make any excuse in the world you want. You can claim this, that, and the other. This is what's going to happen. It has never been wrong. There's no guesstimating. All right, moving on. We talked about recessions. Still don't see the signs of a recession. Did you catch those retail sales on Wednesday, folks? Nonetheless, we've talked about the leading economic index. And the reason why I bring it up again is because we're going to get the LEI, leading economic index, tomorrow. But usually this will peak 7 months in advance of a recession. On average, the average from the peak in past cycles, going all the way back to 1959, it peaked 7 months on average before a recession. Sometimes it was 14 months, 20 months, 1 month, but on average it's 7 months. I raised the monthly retail sales because that's part of the leading economic indicators within the LEI. Major bear markets, and this is from the Sentiment Trader, also major bear markets, 1 to 2 year long major bear markets occur when the LEI are below the 12-month exponential moving average, not above. And we are above the 12-month exponential moving average. And this chart basically shows you a dollar invested in the S&P 500 when the LEI is above the 12-month exponential moving average. You want to stay invested. You want to buy dips. You want to buy corrective waves. All right. Did we know that the monthly retail sales was going to be strong? Kind of. I mean, look at the January trend. We were still growing mid-teens. Mid-teens. This is the Johnson Redbook retail sales. It's delivered every Tuesday morning. It's high-frequency data. It comes out every week, as opposed to the Census Bureau data, which comes out once a month. And it recognizes a sample size of about 9,000 retail points of location throughout the United States. And it showed the year over year, 14.4% in the first week of January. You'll also notice the trend. We drop off into a new month every single month. People have to pay their bill. And then they start spending again. And then people have to pay the bill. And then they start spending again. People have to pay the bill. And then they start spending again. But, this was very strong. So indeed, we were of the opinion that we were going to see a very healthy monthly retail sales. And it was almost double, the consensus estimate at 3.8% on a month-over-month basis and up 13% year over year. Folks, these are mid-teen double-digit retail sales in the face of a 7.5% CPI, Consumer Price Index. Keep in mind, inflation is not just prices rising. There's another component. Think of it this way. If a loaf of bread increases by 15 to 20 cents, right? A loaf of bread increases 15 to 20 cents, but your wages increase 30 to 50 cents. Is inflation impacting you other than the visual? Is inflation impacting your wallet? No. Inflation is not just rising prices. Unfortunately, media would have us, only think about prices rising, only focus on the prices rising. They're not focused on, can the consumer actually absorb higher prices? And clearly, they can. Double-digit retail sales growth, retail sales at an all-time high. But you wouldn't get, the media is going to do everything that they can. Why the surge in retail sales is not as good as it looks? Shut up. Like, if you read this article, it's just, come on. That's what you want to say. Just come on already. The overall strength in retail sales is undeniable, folks, even though many will try to downplay the strength. The article above is just one perfect example of how the financial media bloggers will take aim at extremely ebullient retail sales data. In the article, the author says, yet the rebound in sales came after a sharp 2.5% decline in December. So it was a bad decline in December. So some of the increase last month was just payback after poor results at the end of last year. No, it's not how it works, folks. Nowhere in this article, and I put the link here, nowhere in the article will the author mention how December retail sales were likely impacted by seasonal factors associated with where Cyber Monday falls. Cyber Monday was actually in November this year, not in December. We had an early Thanksgiving, not a late Thanksgiving. That's what impacts the data mostly. But again, they'll try. Be careful. Be careful with remember, some of the stuff that these folks that, they're not experts. There's really no such thing as an expert economist. Otherwise, why is this, the Citi Economic Surprise Index, why does that even exist? Why do we have to have something that says an economic surprise index? Because they suck at what they do. They suck at forecasting economic data. So the term expert is used loosely there. But be careful, what you're in terms of how much you pay into these articles, how much you read into them, and how much you're extrapolating from them in the way of useful information. Case in point, the official said Zero Hedge, which has 1.2 million Twitter followers, published articles created by Moscow-controlled media that were then shared by outlets and people unaware of their nexus to Russian intelligence. This is from the State Department, folks. The U.S. intelligence office officials on Tuesday accused Zero Hedge of this type of, you might say, nefarious activity. Are you familiar with Zero Hedge? If you're not, let me give you the lowdown here. The two main gentlemen that run Zero Hedge, they have both been banned by the SEC from trading securities in the United States. Like, what do you expect from these guys? That's Zero Hedge, folks. Be careful. All right, so fantastic retail sales. The leading economic index is at 12-month highs, 24-month highs. What does this all lead to? Well, net profit. And again, the inflation's going to eat away at margins. Inflation's going to eat away at margins. Really? This is the net profit margin for the Q4 21 period versus the Q4 20 period. S&P 500, 12.4% gross profit margins. Net profit margins. Here's where it was last year at 11%. We have to hike rates though, right? Like, why? What's the problem here? Seriously, what is the problem? Why do we have to hike rates? What's the problem? Who's getting hurt here? Corporations are doing phenomenal. Obviously, the average household is doing great. You don't like higher prices? Then don't like them. But why does the Fed have to do anything? Why does it? It's fear. It's what it comes down to. We're not used to see. We haven't seen inflation like this since 1982. Since 1982, that was the last time the CPI was at 7+%. It's just fear. People are afraid that prices will just continue and continue and continue. Let it. The same people that are pounding the table that the Fed has to stop this, the Fed has to stop this, the Fed has to stop this, are the same people that cry a foul when the Fed stops, well, basically bear markets, recessions. Why can't the Fed let the market clear? Why can't the economy take a dose of its own medicine? Okay, well, then let's do that. Let's let the economy take care of itself. No, see, they like bear markets. It's okay when it's a bear market to scream that the Fed should leave it alone. It's okay when it's a recession that the Fed shouldn't pump liquidity into the system and shouldn't print money. But it's not okay for the Fed to just let the economy take care of itself when things are going really friggin' good. And when the lower wage earners are actually seeing their wages increase at a faster pace than the higher wage earners. Talk about a double standard, or it's ridiculous. It's really ridiculous. Earnings are climbing. Market's not, so we're getting multiple contraction. And I'll remind you that, our price target for the S&P 500 is 5120. Now I get it. That seems like a lofty feat of strength will need to be accomplished given where the S&P 500 is today. But we're not ready. The conditions aren't there presently for us to modify or revise our price target. Just not there yet. They might be at some point, during the course of the year, but they're not there yet. Doesn't mean that other firms are not, revising their price target. Goldman Sachs did. They lowered their price target from 5,100, I believe, to 4,900 on the year. They've lowered their price target, but they still think the probability is that we're going to have an 8% return this year. Too many people, folks, too many people, too many investors fear large annual drawdowns. They focus on what could go wrong rather than what usually goes right. And you can't change what's going to go wrong. You can't change the price of the S&P 500. Seth, I just subscribed to Finom Group. I'm still down. I can't change the price of the S&P 500. You didn't subscribe to Finom Group because you thought we could change the price of the S&P 500. I hope you subscribe to Finom Group. I hope you're a member of our community, because we have very strong analytics. We have an extremely strong track record of analyzing the macro market data. And we have a very strong investing and trading regimen and success rate as well. But we can't change the price of the S&P 500. It is what it is. Don't focus on this potential. Don't focus on that, folks. You can't do anything about that. Pay too much attention to this, and you're forgetting about what happens thereafter. You're going to get stuck in this hole. S&P 500 dropped 45% from 2008 into the trough of 2009. But then it rallied. Folks, 616% over the next 10 plus years. Forest for the trees, as they say. Forest for the trees. Right now, that forest is getting muddy. I think that's the best way to put it. All right, so thank you for joining us again here, folks, on our weekly State of the Market. Maybe we get a power hour rally. Maybe we have a good end to the trading week tomorrow. The headlines are really catching those algorithms right now, and you just have to consult your game plan. Keep your wits about you in this environment, and know that this too shall pass. These waters may be treacherous right now, and the storm clouds are certainly brewing, but we'll get by this. We'll get through this phase as well.